Welcome back to Financial Accounting. I'm recording this video on Friday afternoon. I do appreciate on Thursday, Thursday, there were quite a few that weren't in class. And some of you may have got the note about the lockdown, but didn't get the note that the lockdown was over. Some of you may have been confused because there was a bunch of signs on the door that said that Accounting 101 was canceled. If you look carefully at those signs, none of those signs had my name on it. And for future purposes, if ever I cancel class, which is very, very rare, I will send a note out to all of you letting you know that I canceled class. So quite a few of you weren't there. So for the benefit of those who weren't there for whatever reason, I'm going to record a couple of little brief videos that will cover the stuff that I covered in class on Thursday when you weren't there, under the assumption that you thought class was canceled. So hope you find these useful, and we'll pick up. So what I basically did in class is we had been discussing chapter 5, which had to do with accounting for retailers. And in the class on Tuesday, we talked about the difference between retailers and service organizations, and how retailers had inventory on the balance sheet and how they had cost of goods sold on the income statement. And we discussed some other changes as well. And we've already distinguished between retailers and service organizations. We've talked about gross profit. And then we got into a very long section of chapter 5, which was the objective 2, describe and illustrate the accounting for merchandising transactions. So in class on Tuesday, we talked about purchase transactions. And then we started to talk about the different types of sales transactions. And I'm going to pick it up here at actually slide number 48, which is a sales transaction that has to do with when we issue coupons to customers when they purchase merchandise. So if we offer a coupon with the purchase of merchandise, this happens to me all the time at Staples. I purchase a lot of stuff at Staples in my role as senior warden at All Souls Church. And quite often I get coupons, and the coupons expire by a particular date, and they're usually a certain percentage off or a certain dollar amount redeemable. So the truth of the matter is, when Staples issues those coupons, they kind of know from past experience what percentage of those coupons are going to be redeemed and for what amount. So if you have coupons that are attached to an invoice, and you know from past experience what percentage of those are going to be redeemed, then you ought to account for those when you actually record the sale. So here's a for instance here. So we offer in May of 2006 or Y6 receipts a $3 off customer's coupon for any purchase over $20. During May, we sold $40 million worth of merchandise, and we generated 6 million of these receipts. So you can say, well, of the sales that we made of $40 million, we've got $6 million worth of receipts at $3. That sounds like $18 million that we ought to account for in terms of these coupons being redeemed. But our experience shows us that only 20% of those coupons are going to be redeemed. So on the basis of that, let's record the transaction. So we've got to record the sale, recognizing our best estimate of the amount of these coupons that are going to be redeemed. And of course, this being a retail company, we also have to recognize the cost of goods sold. So when we record the sale, we don't actually record $40 million worth of sales. So let's assume all the sales were for cash or MasterCard or Visa or whatever. So we got a debit to cash of $40 million. The amount that we actually credit to sales is reduced. The $40 million is reduced by my estimate of the amount of these coupons that are going to be redeemed. So we got 6 million of these coupons of $3. Our estimate is that 20% of them are going to be redeemed. So at the point that we record the sale, it's not $40 million, it's $40 million less our estimate of the coupons that are going to be redeemed. So, and that the way we calculate that is 6 million times 3 times 20% gives us 3,600,000. So that is a payable that we actually set up. And as these coupons are redeemed, we're going to debit the payable at the time that the coupon is actually redeemed. Right? So, oops. So we record that. We record the sale. And now, of course, we have to record the cost of the sale, and the cost of the sale is given at $21,500,000. So note, when you record the sale, if they've got coupons, the amount of the sale has to be reduced by my estimate of how much of the coupons are going to be redeemed. So this becomes a liability. So we talked about that. Okay. and the liability reduces sales. And when customer redeem the coupons, we're going to actually reduce that payable. So let's continue the illustration here. And the illustration says, we're on slide 52 here. Assume that in June, Grand sold 52,500,000 of merchandise that cost 28, and that 800,000 of the customer coupons were redeemed. Grand should record its June sales as shown on the next slide. So when we record the sale of 52,500,000, we have to account for the fact that 800,000 of these coupons are redeemed. 800,000 times 3 is 2,400,000. So the amount of the actual sale for the period is not $52 million. The amount of the sale is 52,500,000 reduced by the amount of the coupon, because for all those sales that we had, we didn't actually collect 52,500,000. We actually collected 50,100,000, which would have been the people redeeming the coupons. Cost of goods sold remains the same. Cost of goods sold was 28,100,000. So there's my transaction. So notice when the coupons are redeemed, we actually are going to be debiting the estimated coupons payable because we had actually set up that liability for these coupon redemption earlier. Okay, so we record the sales for July and August in a similar manner. And then we have a situation where, that we estimated the amount of the coupons. So what happens now if we've got a balance of 175,000 sitting in that coupon payable account, and this is now expired? So if it's expired, that means they can't take advantage of the coupon. So we simply reduce the estimated coupons payable by debiting it. We bring it down to a zero balance, and then we recognize that as additional sales. So that assumes at the end of the period, there was $175,000 credit balance, unused balance in the coupons payable. So that was our estimate. So probably we overestimated the amount of the coupons that were going to be redeemed. Let's assume we underestimated the amount of the coupons that were going to be redeemed. Let's assume there was a $50,000 balance in there because they actually redeemed more than we had estimated. So then we get to bring the estimated coupons payable down to a zero balance. We have to actually credit it by $50,000. So we reduce sales, and we credit the estimated coupons payable account to bring that down to a zero balance. Right? So we also have rebates that we have, and rebates, these are recorded at the time of sale, just like an internet coupon. So we reduce revenue at the time of sale. We also have sales returns and allowances, okay? And if the buyer has already paid for the refund, we have to make an actual cash refund to the buyer, right? So we know from prior experience, we can pretty much estimate when we record the sale, how much of the sales are going to be returned. So assuming we've been in business for a while, we can figure that out. And if we're going to re-estimate the amount of the refunds that we're going to have, we can also estimate the amount of inventory that's going to be returned to us. Remember, every time we make a sale, we're reducing the inventory by the amount of the sale and increasing cost of goods sold. So if we're going to estimate the amount of the refunds that we're going to receive, we're going to set that up in advance. We also need to estimate the amount of inventory that is going to be returned to us. So to illustrate this, let's take a look at this. To illustrate this, let's assume let's estimate that from the fiscal year 7 sales, we're going to have a refund of $7,000. It's going to have to be refunded. And we estimate that of that $7,000 of the stuff that's going to be refunded, we estimate that the cost of those goods that are going to be refunded, the stuff that's going to go back in inventory, is $5,500. So we would make these adjusting entries here. We would debit sales for the amount that we estimate is going to be returned to us. And then we would also have to estimate the amount of inventory that's going to be returned to us. So this is kind of phantom inventory there. We don't actually have it in inventory, but we make an assumption of how much is going to be returned to us. Right? And now when the customer actually, we actually have to make a return. If we make a return, so we're giving a customer a return of $1,800, they want their money back. We actually reduce the customer refunds payable, which we accounted for previously. We reduce cash, And notice what we do here now. When the goods are returned to us, we actually put them back in inventory by debiting inventory and crediting the estimate that we had made of the inventory returns. And if this is going to be a buyer has already paid for merchandise, so if the buyer has already paid for merchandise, we're going to debit the customer's refund payable and we're going to credit cash. We told the customer it was an $1,800 sale. We said, look, you keep the inventory. And this often happens, like you buy stuff on Amazon, you're unhappy with it, you call them up and you say, look, I want to return it. They say, keep it. So there's no, assuming the customer keeps the inventory, there's no adjustment to cost of goods sold. Right? So there would be the little memo that would reflect, credit memo, to reflect that we've made an allowance for their account for a damaged shipment. And so we're going to debit here. If it's an adjustment to the account, we're going to debit. So here we paid a refund to them. So if we're going to give them an adjustment, rather than paying them back in cash, we're actually going to adjust their receivable. Then it would be a debit to customer, refunds payable, and a credit to accounts receivable. Right. Last thing I want to talk about here, two things before we take a little break here, and I'm going to ask you to do some exercise. Freight. So you've often heard in business terms, the question will come up: who's paying the freight? Who's actually paying for the cost of shipping the goods to the customer after a purchase? So if the goods are free on board shipping point, that means the buyer is responsible for the freight charge. So in this case, the customer purchased merchandise from Magnet Data for $1,200, free on board shipping point, which means that they're responsible for paying the fee of the $50 on the freight. So to record the transaction here, I debit inventory, I credit accounts payable. That's to record a purchase on account. And then when I pay the freight charges, since we're using a perpetual inventory here, the cost of getting the stuff, of the shipping the freight in, actually becomes part of the cost of the inventory. So I debit inventory and I credit cash. So that's the case of free on board shipping point. We could also have free on board destination, and free on board destination means that the shipping charge is actually borne by the seller. So let's assume that Net Solutions sells merchandise on account. So we sold merchandise for $700, free on board destination, which means we're responsible for the freight, and the cost of the goods sold is $480, and we pay the $40 freight charge on June 15th. So to record the sale, it's simply a debit to accounts receivable and a credit to sales. And then we record the corresponding cost of goods sold. And then when we actually pay the freight bill, we debit the delivery expense and we credit cash. So if it's free on board destination, that means the freight charge is actually borne by the seller. Okay, let's take a look at another example here. Seller may prepay the freight, even though the term is free on board shipping point. So we may say that the goods, the freight charge is the responsibility of the buyer, but we may choose to pay the freight bill in advance, and then we're going to make that part of the receivable due from the buyer. So let's take a look at this example. So we sold merchandise to the planner company on account, terms $800, free on board shipping point, which means the buyer is responsible for the freight charge of $45, and the cost of goods sold would be $60. So we're going to record the cost of the sale. The cost of the sale and the freight shown as follows. So we debit accounts receivable for the amount of the sale. We debit cost of goods sold and credit inventory for the cost of the inventory. And then we also, when we pay the freight bill, we debit accounts receivable because we expect to collect that money from the buyer, and we credit cash. Now notice if the buyer is going to go ahead and take a discount for early payment, that freight charge of $45 would not be included in the calculation of the discount. Right? So just a little graphical here in terms of free on board shipping point. So free on board shipping point means that the buyer is responsible for the freight, and the title actually passes to the buyer at the point that the goods end up at the shipping point. So they end up at the Federal Express or Staples or wherever else you're shipping the stuff out. Once they get there, then those goods are no longer in our inventory. They become part of the buyer's inventory. So that's if it's free on board shipping point. Free on board destination means that the seller pays the freight and the title doesn't actually transfer until the goods actually arrive at the buyer's place of business. All right. So let's just do one or two more quick things, and then we'll take a little break here. Sales discounts and trade discounts. So trade discounts are really very simple. When I go into Staples, I'm a member of the Port Jefferson Chamber of Commerce, so they knock 10% off the sale. So every sale, if I buy $100 worth of goods, it's not a $100 sale. It's a $90 sale. Pay no attention to that phone. Thank you. So that's pretty simple. But sales tax, I have a responsibility as the seller to collect the sales tax from the buyer and then remit that to the state. So every time I record a sale that has sales tax on it, I have to record the sale, and I have to record the amount of the sales tax. So let's assume we sold a $100 item, and the $100 item is subject to a $6 sales tax. So I'm going to debit accounts receivable for not $100, but $106, which shows that I have a liability here to pay $6 to the state, and I have to collect that money from Lemon and Company, and I got to remit that to the state. So companies actually have to file sales tax returns, just like they have to file income tax returns and payroll tax returns. And then when it comes time to pay the tax that I collect, I simply debit sales tax payable and I credit cash when I remit that sales tax I have collected to the state. Trade discounts, I mentioned, that is just off the top. So if you get a $100 sale and it's got a 10% trade discount, the amount of the sale is not $100, the amount of the sale is $90. Okay, so let's take a break here. And what I would like you to do, now that we've taken a break, I would like you to do exercise 3, exercise 4, and exercise 5. So do exercise 3, 4, and 5. And I'm going to do a little video reviewing those exercises, but stop here and go and do exercise. It's in your text on page number 278 is exercise 3. Exercise 4 is on 278, and exercise 5. These are the practice exercises there. And come back and I'll do a little video reviewing the solutions. Okay. See you later. Hasta luego, au revoir, adios. Till we meet again, which should be shortly.